to your suggestions and comments. So this paper is about VAT, and VAT has seen phenomenal expansion in the last few decades. And this expansion in large part has been driven by two factors. So one is VAT is a production efficient tax. So it does not tax inputs of a firm. So the production decision of a firm remains undistorted by this tax. So in other words, this tax preserves production efficiency. And the second reason is that among the class of production efficient tax instruments, so VAT is not the only tax which preserves production efficiency. There are other, but among this class of instruments, VAT is considered perhaps to have the best enforcement properties. By enforcement properties, I mean that VAT is considered self-enforcing. Recently, however, this consensus on the desirability of VAT as a production efficient, self-enforcing tax has begun to weaken. A few cracks have begun to appear in this consensus. For example, Malaysia has abandoned VAT for a sort of turnover tax, and Zambia came quite close to doing so last year. So the discontent with VAT, which by the way is not limited to these two countries, stems from two known sources. So first is this last mile problem. So whatever forces of self-enforcement are built into a VAT. So they break down at the last production stage where sales to consumer take place. And from that point backward, the tax has the potential, the self-enforcement has the potential to unravel. And the second reason is VAT almost as a principle is collected on the destination-based design. And then under the destination-based design, any tax collected on inputs of a good is refunded at the time of export. So the idea is that exports should be free of all domestic taxation because the consumption is to be taxed at the country where goods are consumed rather than where are produced. So this zero rating of export necessitates payment of refunds. And in countries where taxation and capacity, where the enforcement capacity is weak, so this payment of refunds, this creates all sorts of issues, all sorts of non-compliance. So we do know the theoretical mechanisms underlying VAT non-compliance. We know them, and we know them for some time. But my sense is we still do not know empirically. We do not understand that how important these mechanisms are empirically. And this is the idea of this paper which I'm presenting today. In this paper, I look at a representative emerging economy, which is Pakistan, and I estimate the total VAT non-compliance in that country. And in looking at this question, I'm helped by a tax reform in the country, a very large tax reform, which reduced the tax rate on 5 major supply chains of the country from 15% to 0%. So now when the tax rate goes to 0, any incentives to misreport your sales or purchases also go down to 0 because there is no tax. So then there is no benefit of misreporting and there is no benefit of tax evasion. So then over time, so the reporting in these zero-rated industries should become truthful. So tax evasion will go down to 0 over time. And by comparing firm behavior over time, I can back out whatever tax evasion was there at the baseline. And I can study the mechanisms which were driving that non-compliance. Now VAT, you know, is by design a tax on value added. So by this design, it can be evaded by over-reporting your purchases or under-reporting your sales. And Why would you want to over-report purchases? So you over-report purchases because it will increase your input tax credit or input tax refund claim. But to do so, you need to have VAT invoice. So over-reporting of purchases results in an over-demand of VAT invoices in a VAT system. So this over-demand gives rise to a phenomenon which is known as invoice mills. Invoice mills are firms who do not carry out any real business activity. So the sole purpose of their existence is to sell and buy VAT paper. So they buy VAT invoices from firms whose real buyer do not need them, and they sell VAT invoices to firms who want to over-report their purchases. So one benefit of the Pakistani context is that I can identify invoice mills in my data, and I can look at their role in facilitating non-compliance of VAT. So a brief preview of result, what do I find? So if we are in a world where all firms are reporting their sales and purchases truthfully, so they're not misreporting, so then reduction of the rate to zero should have only beneficial effect on activity in those zero rated sectors. So it will have beneficial effect because from both demand channel, when tax rate goes to zero, demand of products sold by you will go up. And similarly from supply channels, so when tax rate goes to zero, whatever liquidity constraints firms are facing, they get relaxed, and so production costs go down. So from both these channels, so there should be stimulation of activity in these zero rated industries. But what I find is polar opposite of this case. So the activity in the zero rated supply chain goes down, and it goes down quite sharply. So then the only way to reconcile this finding is that some misreporting was going on. In fact, substantial over-reporting was going on at the baseline, which is uncovered by these behavioral responses. And using these behavioral responses and combining them with some accounting identities, I can estimate the evasion rate which was there at the baseline. And the evasion rate that I get is really large. So it's 77%. At the baseline, 77% of the true tax liability was not being paid. This is quite a high rate. And this high rate is because the problem of VAT non-compliance is worse in export-oriented supply chains. So in export-oriented supply chains, government loses revenue from both sides. From both sides because it collects less than what is due, and second, it pays as refund more than what is due. So due to these, the export-oriented industries, the problem of VAT non-compliance is worse. But combining my estimates with the baseline distribution of firm characteristics, I can calculate the evasion rate, which is representative of the universe of VAT filers. And I find that rate is close to 38%. 38% of VAT liability was being evaded in the country, in Pakistan. Okay. So to fix ideas on how VAT non-compliance takes place, now consider this supply chain, this very simple supply chain. It consists of only 3 production stages. I have highlighted 2 points with red arrows in this supply chain, and these red arrows, so they indicate the vulnerable points in this supply chain in terms of VAT non-compliance. So if you look at these transactions, so they're all firm to firm transactions other than this. if you consider any farm-to-farm transaction, for example, this one, so this transaction creates paper trails. It creates paper trails because this transaction is recorded as sales by this farm. This is recorded as purchases by this farm, and a paper flows between two farms. That paper is VAT invoice. So because of this double recording of a transaction and the flow of paper between the two farms, government receives information which they can use to enforce the tax better. So this is the self-enforcing feature of VAT. VAT is self-policing because of these information trails which are generated on farm-to-farm transactions. But if you look at this transaction here, sales to final consumer take place. This is business to consumer transaction. So there are no paper trails here because the consumer does not need a VAT invoice because they don't have to claim VAT credit. So the paper trail breaks down here. And because of this breakdown, so there are two consequences. So one is that this firm has greater ability to misreport these transactions because there is no paper trail. So the costs of evading evading tax on such transactions is lower because there are no paper trails. And the second consequence is, if you look at these firms, if this firm underreports its sales and does not do anything about purchases which are coming from these sites and which are recorded, which are documented, which are covered by paper trails, then over time, this firm will end up with negative value addition because they are underreporting sales. They can't do anything about purchases. So they will, in their VAT records, they will end up with negative value addition, which is not sustainable over the medium term. So this firm has an incentive. So they don't have a paper trail on this side. So they have an incentive to eliminate trail coming from this side. So to do that, what they will rather like is that their buyer does not issue them a VAT invoice and does not report this transaction in their VAT records. So this is the unraveling of tax that I alluded. So because of lack of paper trails here, so this non-compliance, this travels backward. So this creates forces for non-compliance to transmit backwards. So this is called unraveling of the tax from the last. This is the last mile problem. This is the last mile problem of VAT because non-compliance travel backwards from here. Now, if we look at the second vulnerable point of VAT, so this firm is an exporter. So whatever purchases are reported here, so at all time, that amount is refunded to this exporter because that is the tax paid on domestic tax paid on intermediates or raw materials acquired by this firm. So this is refund. So whatever is reported here, at all times that amount is this firm's refund, the money which this firm will get from the government. So because of this, so this firm has an incentive to over-report their purchases. So they would like to over-report their purchases because this increases their refund. So now if you look at overall scheme, so this firm will like to under-report its purchases because they want to eliminate paper trail. This firm wants to increase their purchase, over-report their purchases because they want to maximize their VAT refund. So this is perfect alignment of incentives. And as a result, so what this firm will do, it will show some of the transactions which are made to this firm in its VAT record. It will book these transactions as have been made to these firms. So this is known as diversion fraud. And diversion fraud, so there are two important things about diversion fraud. So one is that diversion fraud is like cross-matching proof. So cross-matching is considered like holy grail of VAT by revenue authorities. So what revenue authorities these days are doing is they are collecting transactional data from all firm, transaction level data, and they're doing cross matching. But this diversion fraud is cross-matching proof, because if you look at VAT records, all these over-reporting of purchases, so whatever they report as purchases, it will match the sales shown by this firm to this firm. And similarly, if you look at here, whatever purchases are reported will match the sales reported here by this firm. So this diversion fraud is robust to the main enforcement measure that revenue authorities around the world are taking these days to counter VAT non-compliance, which is cross-matching of VAT transactions. The second thing is, because of this diversion fraud, I have already alluded to it in my preview of results. So the problem of non-compliance is worse in export-oriented supply chains, because government loses from both sides. Government loses revenue from this firm because the transaction made to these firms are not reported, and so the whole VAT on value added by this firm gets lost. But the second loss that government suffers is that it has to pay this firm refund, which is strictly greater than what is due. So they are losing revenue from both sides. Okay, so the last point I want to make here is, if you want to estimate total VAT non-compliance in a supply chain like this, all you need to know is two things. It's sufficient to know by how much these sales are underreported and by how much these purchases are overreported. So these are purchases meant for export, and these are sales made to final consumer. If you want to estimate VAT non-compliance throughout supply chain, you want to know only these two things. Why it is so? Because everything else nets out. So even if there is some misreporting going on here, it nets out. If this firm underreports its sales to this firm, but because this is a firm-to-firm transaction, so this firm has to underreport its purchases. So this will match and this will be cancelled out as long as there is no one-sided evasion. So all evasion, it gets accumulated into 2 points, whatever is reported here and whatever is reported here. And if you know these two things, you can estimate the total evasion. Now VAT is, so you live in South Africa, and you know that VAT chains are rarely complete in practice. So because of these small, informal, unregistered firms, so some part of the production process almost invariably occurs in firms like these, so which are not registered, which are not strictly in the tax net. So what happens when some firm so when VAT chain is broken, or when some firm in the production network is not in the VAT net. So in this example, so I have indicated that this firm is outside the VAT net. So this firm is not registered. So when VAT chain is broken, so the consequence is that whatever VAT is paid at this stage cannot be claimed back as input tax here and here. So the tax paid here, this firm is registered, this is not. And because this cannot transfer VAT to this firm because it's not registered, so the tax paid here, it becomes part of the price and creates production inefficiency. So now if you again look at incentives, so this firm will like to have invoice directly from this firm, but they cannot do it because the middle link is broken. So to fill this gap, sometimes these firms appear, which I'm calling invoice mills in this paper. So what they do is they place themselves in the gaps like this. They will buy invoices from this firm. They will sell invoices to this firm. This firm will happily sell invoices to this firm because their real buyer is unregistered and doesn't need it. So if they can make money on the side by selling invoice, they will do it. And this firm, they will happily purchase invoices from this firm because that will give them the refund. So this will increase their refund. So this is what invoice mills do. And invoice mills, as you can see, they combine two purposes. They fulfill two purposes. So one of which is useful and the other not so. So the useful feature is that because they transfer the input tax entitlement from this firm to this firm, so they restore production in efficiency. So they restore production efficiency in the supply chain in the sense that inputs of these firms, they remain free of any built-in tax. But the bad feature of invoice mills is they always combine a diversion fraud within them, because this firm has no incentive to buy invoices from here, because they want to underreport their purchases. So they are not on the lookout for invoices. So which means whatever input tax goes into this leg of the supply chain, that is also claimed by this firm. So there is always some overclaim of input tax because of the invoice mill, because it combines diversion fraud in it by construction. Okay, so to give you some brief preview of the context which I'm dealing with. So I explored a tax reform from Pakistan, which reduces the VAT rate on 5 major supply chains, which are textiles, leather, surgical goods, export goods, carpets. So the tax rate was 15% up to 2005, and it was reduced to 15% from July 2005 onwards. Okay. The second feature I want to talk about is how do I identify invoice mills in my data. So invoice mills, as you would have noticed by now, is a fraudulent enterprise. So being fraudulent, so they take great care in disguising themselves as normal firms. So it is not easy to identify them in the data. So what I'm helped with here is that Pakistani tax administration, so they uses a legal process. So in this legal process, any firm which they feel is involved in its selling or purchases of VAT invoices, they suspend the registration of that firm. And after suspension of registration, they carry out a small audit and give the firm a show cause notice and ask them to respond to the charge that they are an invoice mill, that they are buying and selling invoices. And if after that inquiry they are not satisfied, then they blacklist that firm. And once a firm is blacklisted, so then their invoices cannot be used to claim input tax. So I observe both blacklisting and suspension in my data, and I use them to proxy whether a firm is an invoice mill or not. And this is data. So the reform came in July 2005. So Pakistan started VAT, a broad-based VAT from 1996. So this is the stock of invoice mills in Pakistan. By stock, I mean the number of invoice mills that file their return in a given, their VAT return in a given month, which is a tax period. And you can see the stock of invoice mills kept on rising and rising very sharply till the reform, when it started going down sharply. So this is the number of returns filed by these firms. And I will also show you the activity reported by these firms. By activity, I mean sales and purchases. And the activity almost collapsed down to zero immediately after the reform. And it collapses down to zero because there is no incentive for selling or buying invoices if the tax rate is zero, because there is no refund to be claimed. Okay, what is the empirical strategy that I use? Empirical strategy I use is difference in differences. So I compare the evolution of outcomes across the zero-rated industries with all other industries. And because I have long panel of tax records, so I can show you through event studies that whatever assumptions are needed for this difference and differences modeled. So those are satisfied. Okay. So now let's start talking about the results. So before I show you the responses generated by this reform, by this reduction of the rate to 0, so it is important to show to you that the tax reform that I'm exploiting is not trivial. So it is important. So it affects farms significantly. So to show that, I will use both aggregate evidence and also micro-based data. So this is aggregate evidence. So what I'm showing here is the total VAT refund paid in Pakistan as a percentage of gross VAT collection in the country. And this ratio was hovering between 15% to 20% before 2005. So which means that almost 20% of the total VAT collected in the country was refunded back to exporters. And so the reform occurred here, and after that, this went down significantly. So this includes all farms in Pakistan, both farms which are in the zero rated industry and also the farms which are not in the zero rated industry. So this is everyone. And you can see that from a peak of 20%, so this refund came down to 5%. So there was like 15 percentage point or 2/3. So the refund paid in the country reduced by 2/3 as a result of this reform. And this is micro level data. So what I'm doing is I'm looking at the input tax reported by farms. What you can see, so this red is zero rated industries, blue is everyone else. And at the time of reform, the input tax reported by these zero rated industries, it crashed down to 0. And it should not be surprising. It should not be surprising because input tax by definition is tax rate times the purchases reported by these firms. And because the tax rate goes to 0 in July 2005, then the input tax should also reported by these firms should also go to 0, and it does. So the purpose of showing this graph is that the size of the shock is pretty large. So the effect of the reform, the first stage effect of the reform is large. And because of this large variation, the firm will be forced to change their behavior. By changing their behavior means whatever tax evasion they were engaging in before the reform, there is no benefit of that tax evasion. So then their reporting should come down to what is the real level of activity carried out by them. So this is output tax, and it performs similarly to, unsurprisingly, its behavior is similar to the input tax, because output tax is tax rate times the sales reported by farm. And again, because tax rate goes to 0, so this has to come to 0. So now these are behavioral responses. So if, as I said earlier, so if farms, they are reporting truthfully, so they are not evading tax. So if they're not cheating, so then just the fact that tax rate goes to 0 should have no effect on them. So they should continue to report the same level of sales and purchases they used to do in the pre-reform years. So the tax rate reduction should have no effect on them, other than that it may have some positive effects coming from the demand and supply channels, which I mentioned earlier. But what I find is very strange thing that the purchases reported by these firms, they drop, and they drop quite sharply at the time of the reform. And then these purchases, they remain low. Similarly, when I look at sales, the sales reported by these firms also drop, but the response of sales is more diffused. It is not as sharp as that of purchases. It comes about over a period of time in a series of gradual movements. And its reason, my sense is, when you have been over reporting purchases over a long period of time, so then in your books, you are carrying a lot of unsold inventories. And unless you liquidate those inventories, your sales will not come back to the new equilibrium. So the sales of these firms, they remain high for a pretty long time because they were liquidating inventories which were built by the over reporting of purchases in the past. Similarly, you can see the exports reported by these firms also went down. So these are the pictures, and you can convert them into numbers by estimating your model. And what I see, so this is the first stage, and these are behavioral responses, that there was there was really large reduction in activity reported by these zero-rated industries. And as I told you, the reduction of activity does not make sense. If the stimulation of activity does make sense and it can be justified, so tax rate goes to zero, firms production gets stimulated because of the demand goes up or because the production cost goes down, but not negative, the activity going down and going down such by so much, by such a large margin. So this suggests that there was some misreporting going on at the baseline. And when the tax rate goes to zero, so there is no point in over-reporting your sales or over-reporting your purchases, and the firms, they started reporting the true amount. Okay, so in terms of technicalities, so what I'm estimating is the difference in differences model. And one assumption we are making in estimating this model is that there is no spillover effects from the treated groups to untreated groups. And so this is an important assumption, and I need to show that this is not the case. For example, in my setup, so the economy is like a network. So it is composed of supply chains and firms interacting with each other in a sort of mesh. So there are like cross supply chain sales and purchases. So one of the ways in which this no spillover effects assumption can be violated is if the reduction of the rate to zero also affects non-treated industries because of these farm linkages, because zero-rated farms are linked with other farms in a complicated way. So to see that this assumption is not violated, what I do here is, the Pakistani Revenue Authority, they use the HS code to classify farms into industry. And if someone of you have worked with, if you have some experience with the HS code, so the HS code organizes industries in a sequential fashion, in the sense that the industries which are close substitutes or complements of each other, so they get very similar coding numbers. For example, if you look at tea, coffee, and cereals, so they are similar industries, and they get adjoining codes of 06, 07, and 08. So if you take any industries, so the next industries to this in terms of classification are the industries which produce substitutes or complements of the industry. So the idea behind this exercise is that if the reform creates spillovers, then these spillovers will be strongest in the industries which are complements or substitutes of these industries. So then look at if there is any differential effect, if there is any differential evolution of outcomes in these adjoining industries. So this is what I do. I drop all the treated, which is zero-rated industries, from my sample and define treatment as the next two digits, the adjoining industries, and look at if there is any differential response of these firms. and I do not find an evidence. All these coefficients are statistically insignificant, which shows that there were no spillover effects in the adjoining industries. Okay, so we are 40 minutes into the presentation, so I will I will expedite to have some time at the end for your questions. So the question is, so I have these numbers, and how to use these numbers to convert one number, which is the evasion rate of VAT. So coming back to this picture again, so what I have is I observe the sales of this firm. So I observe, a number that I have is by how much exports reported by this firm go down. But I do not need this number. What I need is by how much this firm's over-reported its purchases. But that's easy, because if I have this site, which is the output produced by this firm, I can always get the input by the production function of this firm. And this is the production function of exports in Pakistan. So I collect all the baseline observations of exports and purchases and draw this bin scattered plot and fit a horizontal line on this. You can see that this relationship is almost linear. So this is log space. A linear curve in log space means a Cobb-Douglas production function with an elasticity of half. So it means exports are a Cobb-Douglas function of purchases with an elasticity of half. So I observe the response of exports, and using that and the relationship which I have estimated here, I can calculate the response of purchases, by which I mean by how much purchases meant for exports were over-reported at the baseline. And using that, I can estimate the evasion of I can estimate by how much refunds due on exports were over-reported. And what I find is that the 23 billion rupees of refunds were claimed in excess of what was due. So this is nearly 22% of all refund claims. They were not genuine. Similarly, the second thing I need for my evasion estimate is by how much the sales made to final consumers are over-reported. But in my data, I do not observe sales made to final consumer. What I observe is sales. So these sales could be to a firm or they could be to a consumer. But here what I use is that if it's a firm-to-firm transaction, then sales reported by one firm are reported as purchases by other firm. But if it is a sales made to final consumer, then that is reported only once. So I collect all sales, then take away these purchases reported by all firms. What I'm left with is the sales made to final consumer. And using these accounting identity, I can estimate by how much the sales to final consumer were underreported. And I find that 38 billion rupees of tax was underpaid on these transactions. And this is nearly 44% of 43.5% of total tax due from this. So in the final few minutes, I want to talk about the role of invoice mills in all this non-compliance that I showed you earlier. So these are invoice mills, and what I'm showing you is the aggregate input tax claimed by these firms, which is I am summing the input tax reported by across all the invoice mills. And you can see, so this is the time where reform takes place. So in these periods, the tax rate is 0. In these periods, tax rate is 15%. So whenever there is a tax cut from 15% to 0%, you will observe some intertemporal income shifting of activity, which means firms, they can shift activity from one period to the other. But this activity should be shifted here because the tax rate is 0 and not here where it is 15%. So this concentration of activity is on the wrong side of this reform. So it should not be here because here they have to pay 15% tax. Here they have to pay only 0% tax. So they can shift it easily to this side, but they do not. So this, which is again an evidence what these firms are essentially doing is they are pumping VAT paper into the system. And here they're doing it like mad because they know from this point onwards, the tax rate will be 0 and the game will be finished. So the game is to get illegal refunds on these invoices. So they have to push these invoices into the system while it's still taxed at the rate of 15%. And this pattern occurs in everything that you see for these invoice bills. And this is the last piece of evidence that I want to show. So the question is, how much excess refund claimed by exporters occurs on the invoices sold by invoice mills or the invoices issued by invoice mills? So here I draw two curves and they are from different data sources. So the blue curve is the input tax claimed by exporters on the basis of invoices issued by invoice mills. And this red curve is the total output tax involved in the sales made by blacklisted or invoice mills farms. And you can see that these two curves, they track each other quite closely. So it shows that almost all of the output of invoice mills, which is the red curve, all of the output shown in VAT records by invoice mills, that ends up as export refund claimed by exporters. And what I see is that 97% of the sales made by these invoice mills, they are made to exporters. So the main purpose of existence of invoice mills is to facilitate fraudulent claim of refunds by exporters. And almost 2/5, 40% of the excess refund claimed by exporters arises only because of invoices issued by these invoice mills. Okay, then I stop now. So in terms of conclusion, I look at VAT non-compliance in a representative emerging economy using a tax reform that reduces the rate to 0. And this gives me opportunity to tease out non-compliance, which existed at the baseline. And what I find is that there are two types of non-compliance in a VAT system. So one is simple, the garden variety non-compliance, which is the underreporting of sales, which occurs in other tax bases as well. But the second and more complicated is where the exaggerated refunds are claimed. And because of these two, the VAT non-compliance is worse in export-oriented industries. And if you recall, I told you that Zambia last year was contemplating giving up VAT in place of a turnover tax. And the major reason was the refund claims of mining industry. And because 97% or 95% of mining output is exported, so they were due large amount of refunds, and they were feeling that they were having difficulty in administering those refunds. So in that sense, that is justified because the non-compliance is difficult to counter in a VAT system on export-oriented supply chains. And I also talked about the role of invoice mills in over-reporting purchases and in the overclaim of refund. I now stop and I will look for your questions. Thanks a lot.